So let's get started to today. As always, you know who this is. It is your coach and educator at Valetax. And this webinar is proudly brought to you by Valetax. And on today's webinar, we're going to be keeping things as simple as we always have done it. And you know what today's topic is. It is why smart money always wins. We're going to be understanding market and also understanding market liquidity. My name is Innocent Ifere Ryan, market analyst and educator for Africa here at Valetax. Okay, so you already know the first two parts about that. One of my major aim and in alignment with Valetax is to serve you, to help you escape confusion with clarity. I have been in the financial markets for close on 6 years this year. And in this time in the financial market, it has taken me a series of rebuilding, relearning, unlearning, and having to master these markets. And today, what I'm going to be teaching you is going to be exposing to you truly how these markets operate. Okay? First things first is the trading illusion. Okay? One of the major things that happened in this market is we retail traders, okay, a lot of people on the internet, on social media, they want to say things like, they want to make it look all fancy, say, oh, we're CFD traders, we're not retail traders. At the end of the day, if you are not an institution and you don't have the liquidity to actually be considered an institution, and you're not a trading desk on your own, you are a retail trader. Okay. So the illusion here is a lot of retail traders chase moves while smart money creates them. Now, smart money, these are the institutions, these are the people with the huge liquidity, these are the people who make millions and billions in transactions every day. They are the sole reason to why the financial market moves every day. Okay. Now, we retail traders also make the market move because at the end of the day, we all have to provide and introduce liquidity to the market. Okay. So here's what we're going to be learning today. We're going to be learning what really is market liquidity and what creates it. What really is this market all about? Okay, what is market all about? We always hear things like market, market, market. What is this market really all about? We're going to understand how the market really does move. Okay. Now, the next thing we're also going to be looking at is what is the foundation of every big trade? Because at the end of the day, liquidity plays a role to why every big trade happens. Then we're also going to look at simple steps to reading liquidity like a pro and common mistakes to avoid, but usually hard. You see that part, usually hard. I intentionally did put it there because a lot of people talk about common mistakes, but the reason why mistakes are common is because they are hard to what? They are hard to avoid, and that's why it's common. So before we get started, I want to make sure we're all following and you're on this call and you're paying attention, you're attentive, and you have your notepad with you. Just leave a fire emoji for me in the comment section. Let me be very sure that you are on the call and you're paying attention to this webinar. Okay, thank you very much. So let's get started, okay, by fully understanding what is liquidity. Okay, liquidity simply is the ease with which an asset can be bought or sold without causing a big price change. I'll take that again, okay? It's the ease with which an asset can be bought or sold without causing a big price change. So put it this way, okay? I like to use regular and everyday market dynamics to explain how the Forex market works, okay? Because there's a whole lot of similarities between the both of them. You can't go to the market to buy, or you can't go to a store rather to buy bread if there is no bread to be sold. Does that make sense? You can't go to the market to buy bread if there's no bread to be sold. Now, the person who owns the store would obviously not be selling bread if nobody wants to buy. So liquidity is the ease. Liquidity is the ease to which transactions happen. It means that at every point in time, someone is willing to give up something to get something. That's the liquidity there. So a buyer is willing to release his money to buy the bread. The seller is willing to release the bread to take the money. So one person is wanting to take liquidity, another person is providing the liquidity that needs to be taken. So liquidity in another essence is money. That's what I mean by one person is providing the liquidity and one person is there to do or take the liquidity. So when we view liquidity as money, as resources, okay, then we want to view it in that way, because there's always someone willing to give a resource to get something in return, and there's someone willing to take that resource to give something in return. That basically is liquidity. Now, according to smart money concept, liquidity refers to the clusters of resting buy and sell orders, primarily stop losses orders that institutional traders target to fill their large positions. Now, I would explain this on the, as we go on the course of understanding what this liquidity is. This in contrast to traditional definition of liquidity, which simply means how easily an asset can be bought or sold. So now when you put together the two things I have said at this very moment, you understand that as much as it's the ease to which an asset can be bought or sold, the sole reason to why that ease is created for that asset to be bought and sold is the presence of one person willing to give something and the other person willing to take it. So you see that they tell you buy and sell orders, primarily stop loss orders. So it means that someone is putting money in the market and is saying, okay, I am willing to part away with this money. And someone is saying, I need a cluster and accumulation of this money in order for me to be able to carry out or perform a transaction. So that is what liquidity is. If you have any questions, please always drop your questions in the chat section, and I'll keep this call as interactive as possible to always answer these questions. So feel free to leave your questions in the chat section, okay? So you see, I dropped a face here where I said liquidity is like oxygen, invincible, but without it, markets can't breathe. So you see that without someone willing to give up something, another person is not going to be able to carry out or to be able to supply. So here is another view I want you to have about liquidity. View liquidity as the interim between supply and demand. So if we don't have supply, if we don't have a demand, there's nothing to be supplied. And if we do not have people supplying, if there are no presence of suppliers, no one is going to be demanding for that good or service. Does that make sense? Okay, if you're following, please always drop something in the chat section saying you're following and you're understanding. That helps me know that we're going along. Okay, so next thing is helping you to understand the difference between smart money versus retail. Okay, most traders focus on only charts. A lot of traders focus on only charts without fully grasping, how the financial markets really operate. Charts are beautiful. Chart works. Understanding technical analysis is very important. But here's the truth about it. Smart money is where a bulk of the market operations happen. See, retail traders, we're basically flowing around and making money or making profits or enjoying and getting entertained by the movement of smart money. We feed off the trickles, the breadcrumbs from them. That's what we're doing a bulk of time. But now, as much as we are taking the breadcrumbs from them, we are still very much an important part of the market. In fact, as a matter of fact, we institute up to 30% of the total market liquidity. Now, the key difference between how smart money trade and how retail traders trade is smart money chases after liquidity in order for them to perform transactions. Retail traders chase price action in order for us to perform transactions. So this is the key difference. Now, this is why, because we're always chasing what smart money isn't going after, we automatically become a part and parcel of this liquidity for them to actually fuel by to carry out transactions. So I would explain it a bit further for you so you can understand it, okay, in the next slide. Now, this is what I mean by we enable them be able to carry out transactions. You see, when retail traders are in the market, we're constantly chasing on how to make profits. we don't pay attention to the hidden things that exist on the chart. We're always about how to get the next move to either move to the upside or move to the downside. We're always more focused on trying to get profit off the market, and we sometimes forget. Sorry, that was a network glitch. Okay, we sometimes forget that we alone don't run the market. That there are people that are bigger than us. So now, what smart money comes to charts to see is to actually look at all the retail traders in the market. Now, mind you, smart money has access to informations that retail traders don't have. They have access to faster executions. They have access to data, corresponding data, like data that are actively changing, that allows them see the footprints of the market. It helps them see where the most money, where the most orders are placed in the market. Now, where are these areas? We refer to them as liquidity zones or areas of liquidity on the chart. We're talking price accumulation zones. We're looking at swing highs and swing lows as liquidity pools or liquidity areas on the chart. And I'll be showing us this on the chart. So let's enjoy for now. Let's enjoy the presentation. And when we head to the chart, it would all start to make sense because while we're charting, I would also be explaining further for you. Okay. Now, the next thing we also want to look at is the types of liquidity, okay, on the chart. So now we're looking at liquidity based off the smart money way, okay? We have what we refer to as the buy side liquidity, and we have what to be referred to as the sell side liquidity. The buy side liquidity is just the pool of, stop loss orders sitting above a recent high, okay? And sell side is the exact opposite of what the buy side is. It's just a cluster of stop losses sitting below a recent low. Now, I want you to view buy side liquidity as the honey above the highs or the sugar above the highs, and the sell side as the honey below the lows. And I'll explain to you why I mean this. You see, when retail traders are taking a trade, we've learned to understand that we're supposed to place our stop losses, at the lows and place our stop losses at the highs. So if you are buying, for instance, you want to put your stop loss under the recent low. If you're selling, you want to put your stop loss just above the previous lower high. Now, these are all good. This was what we were taught. But let me give you perspective. You see, when someone needs you to be able to manipulate you, he teaches you how to put your mind or fix your mind on one thing that is supposed to happen recurrently. He tells you what to do. So view smart money as the puppet makers, or the puppet players. We are the puppets and they are playing us. They teach us what they want us to know so that it makes it easier for them to find us. Does that make sense? So why I say we are the honey above the highs and the honey below the lows is because a bulk of traders, retail traders, are taught to put their stop. In fact, when you come into the market as a beginner, the first way you're taught to place your stop loss is when you take a trade, put your stop loss under your entry position, or if that's for a buy and for a sell, put it above your sell position, or you find the most recent lower high and place it there. Now, the truth about it is the most recent lower high is what? What did we say are types of liquidity? A buy side liquidity and a sell side liquidity could just be a possible buy side liquidity or a sell side liquidity. So at the end of the day, you just become what? A part and parcel of a liquidity pool that is resting around that region. And what happens when they eventually decide to use liquidity to fuel a transaction that they're about to make? They need those monies. So those monies that we keep leaving in the market is how they fuel their transactions, because they can't move in a certain direction if nobody is willing to what? To fuel the direction. So like I said, nobody is going to be able to buy if nobody is willing to sell, and nobody is going to sell if nobody is willing to buy. So in order for them to, for instance, take a buy position, they need your sell orders. And in order for them to take a sell position, they need your buy orders. So your money helps them fuel the transaction. Are you following? Okay, let's keep going. So I'll take you somewhere. If you're following, say I am following in the chat section. Let me be sure that we are following. Okay. So now, why smart money always wins? The truth about why they win is they create traps in the market. They use retail stop losses as entries. They think in terms of flow, not isolated trades. So this is what I mean. Remember, I said they understand the footprint of the market. They have an aggregate of how much is in the market at every point in time. So, take for instance, let's say on the Euro USD, for instance, smart money wants to place a trade or they want to complete a transaction. Basically, most times they are not really even placing trades, they are completing transactions. That's why I'm using transactions, because they are not always traders. These are banks. So we could have maybe the Bank of England trying to close a deal for a multinational or a transnational company worth over £2 billion, for instance. Okay. In order for that transaction to move, it simply means that there need to be a presence of £2 billion on the pound dollar. So the GBP USD needs to have a total liquidity pool of £2,000, £2 billion. Now, if the direction in which the market is supposed to head to, probably they want to buy more pounds above the dollar. Okay. So what you're going to be looking for is want to see a buy on the GBP USD. Now, if the liquidity at the top side, for instance, okay, doesn't have £2 billion to complete that transaction, do you know what's going to happen? Smart money would start to induce liquidity into the market. Why is it going to induce liquidity into the market? It's going to start to invite more sellers. So the more you're selling, the more you're placing your stop losses above what? Above that previous lower high, creating what? A possible buy side liquidity for them. So they need to create more of that money to be able to get and make sure that they have £2 billion in the market to fuel that transaction, so that by the time they click buy pounds, they can actually do what? Complete the transaction of buying £2 billion. Are you following? I'll show you this on the chart, but I want you to kind of mentally, okay? I want you to kind of mentally visualize it. So if what they have presently in the market is just probably £1.2 billion, for instance, now they would keep stalling the market. That's why you see that prices might probably start to range. Okay, it just keeps ranging at some point. So what they are doing now is they are inducing, they are trying to bring more retail traders to actually see what is happening in the market. And sometimes smart money creates patterns. So when you see patterns, don't be so excited. They create these patterns to actually trap more liquidity in the market. And then all of a sudden, you find a very huge move would happen. Or these banks actually wait for when there's a high impact news in order for them to actually fuel or actually place this transaction or carry out this transaction. Why? Because they now have more liberty to execute such huge amount of trades. Or smart money tries to place their trades within structure and place it bit by bit by bit by bit. So that's why you see that there's a lot of order blocks in the market. So you've heard of order blocks. So when smart money cannot fulfill a transaction, they start to keep order blocks in the market. So what they use order blocks to do is they use order blocks to carry out these huge transactions in bits by pieces. And even by doing that, they intentionally still manipulate the market. That's why you have something we call an internal structure or an internal liquidity raid. So those internal liquidity raids is still a way for them to actually do what? Increase liquidity so that they can what? Fuel more money even in shorter spaces. Flow with me. Flow with me. I want to make sure you're flowing with me. I want to make sure you're following, because what I'm telling you right now are like how the market actually moves that a lot of people don't talk about. A lot of mentors and educators out there might not be giving you what Valetax is giving you right now at this very moment. So you see, when all of this is happening, yeah, that is how a lot of people are getting stopped. You take a trade, your stop loss is hit, prices moves your direction. You take a trade, your stop loss is hit, prices moves your direction. They need to constantly use this liquidity to complete transactions. Okay, so let's go to the next thing. This is a typical example of a liquidity grab in action. So I want you to look at this picture very well, and then finally you have a picture that you can use to complement the mental image I've been trying to help you create. Can you see how we were at a resistance point? So this is a buy side liquidity. You see how we got to this point here, acted as a resistance before. Now, what you've been told is resistance zone, and every time prices comes to a resistance zone, it touches the resistance, it makes it what? Even stronger. And prices are supposed to do what? Sell from that point. So 2 touches at a resistance level gives you what? Gives you more confidence at that resistance level. But what if I told you that that was a possible trap that you've been falling for and it was never explained to you properly? So in accordance to the laws of structure, resistance are not really the most important things for you to pay attention to when you are, in a bullish market. But we'll leave that for when we actually come back to talk about structure in our next episode of this webinars. But let's talk about what played out here. You see how a lot of sellers constantly kept coming into the market at this point, trying to sell at this point, and all of a sudden, what happened? Buyers came into the market, raided every possible stop losses that was above here. Not just do that, but in fact, even induced more buyers into the market, and then prices started to reverse to the downside. This is a typical example of what? This is a typical example of a liquidity grab in play. Why? These sells were valid to have happened here because why not? This was a good resistance level that had shown prowess before. So here was a good place for a lot of retail traders to have sold off from. But now what happened? A lot of retail traders sold, they had their stop losses above there. In fact, some even tried to play it safe and say, you know what, okay, I won't place my stop loss directly above it. I'll place it a bit higher. And what happened? They did in fact sweep everybody. There's no possible way you'd have your stop loss so high. They swept everybody and also did what? Induce buyers into the market and reverse prices back to the downside. And eventually what happened? This market actually continued to sell up until this point here. By the time I open my chart for the week, you would see that prices sold off to this point. So you see that the sells were not wrong. But in order for them to allow these cells come into the market, they needed to fulfill a transaction. So what did they use? They used here as a liquidity what pool. So they kept inducing what sellers. You can see prices sold off here a bit, and prices came back here again, and a lot of people tried to sell again. And what did you see here? Notice what everybody can see here. If you're not a beginner on the chart, what you can see is a possible what? A possible double top. So you see why I tell you that patterns is another thing that they use to trap retail traders. You see a pattern and you're excited. You're like, oh, so excited. It's all a trap. It is all a trap. Now you want to place a trade. Now you want to, put money on this trade. And why? The moment you put money, you've done what? You've created liquidity. Your stop loss is you saying, okay, I'm letting go of $100, $200. Now, mind you, it's not just you. It is millions of traders at this particular zone that are seeing the same thing. Now, what is the number one rule of every magic trick you've heard of? It's an illusion, yeah? And what do you always hear? The more you look, the less you see. That's why they need to use patterns. Because what you're looking at right now is a clear opportunity for a double top. So the more everybody is looking at that point, what are they seeing? A double top. They are seeing a double top. They're seeing a double top. So everybody is seeing a double top. The more you look, the less you see. The more you look, the less you see. So you're placing the trade. You're like, oh, high probability, double top. You're placing your stop loss. You're placing your stop loss. There are multiple people placing $100, $200, $1,000, $10,000 stop losses at these zones. So what happens? You're constantly putting what? More liquidity. Now, imagine a million people put $100 stop loss at this point in time. What does that generate? More liquidity. So finally, if they had a transaction that needed to be completed, they just use all of this liquidity to do what? To fast track that transaction. And when they are done, they reverse the market immediately. So what do? They carry out that transaction and then they make even an extra profit on that same trade. So they complete the transaction and then they reverse the market immediately. Because why have they done? Now they've taken both the buy side liquidity and the internal liquidity of buyers that were trying to buy after this break. So they've taken everybody out of the market. Because why? People who bought after this market would be trying to swing it. And then where do they now have their stop losses? They now have their stop losses under these lows too as well. Why? Because they are taught that they should use the previous what low as their possible area of stop loss. So what have they done? They've taken both buy side liquidity and taken both sell side liquidity. Perfect smart money raid. Are we following? Are we following? Am I talking too fast? Am I talking too slow? Let me know, guys. Let me know, guys. Okay, so I hope you're following and you're understanding. So the next thing we're going to now look at right now is how to spot liquidity and applying them to your trading style. Yeah, step by step. So first things first was we want to identify structure. We want to look out for accumulation points. We also want to mark out our previous swing highs and swing lows. We want to mark out our previous session highs and lows or closing range. I'll explain this. Okay. Then we want to identify our possible areas of supply and demand that could be inventing liquidity or inducing liquidity. Then we also want to look at risk management and the result. So I know this part you've not seen it in anything we spoke about previous session highs and session lows, and I explained that to you. So the reason why we have sessions in the market, I believe if you're not a newbie, complete newbie, you understand sessions, New York session, London session, Asian session, Frankfurt, and all of these places is these sessions exist because it is at this point in time where the central banks and also the commercial banks and also the stock exchange of every country or that region is open. So for the US stock exchange and the central bank, it opens at the New York session, the London session as well. Now, the reason why these session highs and lows are important or closing and opening ranges are important is because when these banks open, that is when they actually carry out transactions. You cannot carry out such huge amounts of transactions without the involvement of the central banks. And that's why things like interest rates affect, commercial banks and also central banks. Okay. Now, this the movement or the transactions that happen usually would happen during these sessions. That's where there's more liquidity because the session with the most liquidity is the New York session. Most obviously is the New York session. Now, when transactions are not fully completed, okay, during these sessions, the next day of that same session, or probably the open of another session, and a transaction needs to be carried out. These transactions could actually go to chase after the orders, the stop loss orders that were lingering around previous session highs or session lows, or the closing and opening range of these sessions. Usually you get closing and opening range during the end of the week. So when the market opens, you have that range that happens. And when the market is closing on Friday, you have that slow down. There are people that are so greedy and still find a way to want to enter the market at that point in time with the expectation that when the market opens the following week, prices would jump in their direction. So those are points of liquidity too as well. So those are some of the things that we're going to be identifying what on the chart. Okay. So let's go back and let's head to the chart, guys. If you can see my charts, let me know if you can see my charts. Okay. Okay. If you can see my chart, just so you can see my chart in the chat section. If you're following so far and you're understanding, please say you're understanding in the chat section. Let me be sure that we can hear me. Okay, so let's use GBP JPY. Okay, for instance, let's use GBP JPY for our analysis so far. Okay, guys, just give me a minute quickly. Just give me 1 minute. Okay, I'm back, guys. I needed to put on my glasses. My eyes were starting to hurt. Okay, so let's go to a new chart. Okay, and let's go to a new chart and let's use O and A for instance. Okay, and let's go to the daily time frame. Let's come to the 4-hourly time frame. Okay, I have analysis here. I don't want to take rid of this analysis. Let's look at let's see, let's try a Pepperstone. Good, good, good. So I want us to look at GBP JPY here. Okay. So on GBP JPY, we see that we can see that prices have been what trending higher. Okay. So what would we identify this as a bullish structure? Okay, and prices is still going higher. So we have a possible resistance level here. Why is this area a resistance level here? Because we've seen prices fail to break above here, 1, 2, also here, and then we finally saw prices do what? Come to this level here. So what kind of liquidity would this then be? This would be a buy side liquidity, but let's keep that aside now. So the first things first that we planned out to do. Okay, so what I'm just going to share my whole screen. Okay, so that we can, for convenience. We said first we want to identify structure. So flow with me. I want to show us how to do this. So we want to identify structure. So this is on the daily time frame, for instance, now, yeah? We want to identify structure. So we had these lows here. Okay. And we did in fact see prices finally come. This lows was what moved prices to take out the liquidity that was resting where here. Because why? Stop losses here, stop losses here, stop losses here. And we finally did what? Take out all of this stop loss. So where did this stop loss get taken out from? Here. This is in fact the liquidity sweep. And one thing you can use to identify liquidity sweep is usually a wick, a candle wick. When you get that huge wick, exactly where you anticipate that those liquidities are resting, when you get that wick, you can then finally say that that sweep has happened. Or you get a very huge candle close and you get another huge candle close back below that level. That's where you then say that the liquidity sweep has happened. So this becomes where the liquidity sweep eventually happened. And these were the lows that did that fueled prices here. But I want you to also notice something. There was this consolidation that was still around this area. And what do you think happened here? It means that there were still people that were trying to sell more positions around this area. People were still trying to sell around this area, hoping that here would still hold as a resistance. And what did we talk about? Engineering more liquidity into the market if the present liquidity at that level is not enough to facilitate that transaction. So that was what happened here. So let me take you to the 4-hourly time frame. Okay. Now, what's the next thing that we want to do? We want to look for accumulation points. So what can we notice here? What can we notice here? Accumulation points. 1, 2, 3, 4, 5, 6, 7, 8, 9. So it means that there were people constantly trying to sell here. Constantly trying to sell here. Constantly. They kept putting money in the market. They kept placing stop losses. And you know what? It's like a rage bait. The person who took a sell at this point in time and had this huge move but never took profit, and prices did eventually come back here, and he starts to see prices stall around this level, what do you think he's going to do? He's going to do what? He's going to double down on his position because now he's angry that he didn't take profits here. So he's going to double down on his position and he's going to do what? Place more sells with bigger stop losses, meaning that if previously his initial stop loss here was 100, at this very point in time now, he might have placed 3 positions and he now has 300 as stop loss at this point. What do you think has happened? He has increased the present liquidity resting at this level. And it's not just him. Remember, the market isn't just you. The market is millions of people. So people who didn't take stop loss here are angry that prices reversed on them. Why would they be thinking that way? Because they eventually sought that this resistance point is a very strong resistance point that should do what? That should actually push the market and reverse prices to the downside so that they can make more money. So they were holding their positions. So you see that the market works psychologically. Yeah, it's a mental game alongside an illusion that is created to deceive you and I. Now, it's not that you're not going to fall victim of it. sometimes it's your ability to be able to discern when it's happening and jump out of the market immediately. Or you finally identify it and play the game with who? You now finally play the game with the market makers. So when you hear market makers, these are people that do exist. They create this market. They force you into the market. They entice you into the market. They lure you in. They know they are masters and they've studied psychology so much that they know where to rage bait you. They know where to make you feel stupid and make you feel very overconfident. You see, they play on two psychological parts of us, our fear and our greed. Your fear comes in when you don't know what is happening, and you're just distorted. Some sort of dissonance is happening with you, and then they play with your greed, which is where you get overconfident, and you want to make more money because you've taken a couple of wins. You now feel like you're invincible. You want to go back into the market, and then your fear also is accompanied with anger. When you're scared, sometimes you can get angry. When you're greedy, you can get angry. Anger is like a very neutral emotion in the market. Okay. So see how they played with everybody at this point in time. They rage baited everybody here, and people kept selling, only for what to happen? They finally swept everybody's liquidity at this level here. So let me just clear off this mess here so that we can see it well again. Um, delete. Okay. So what did they then do here? No, I'm going to use my pen instead. Okay. So what did they then do here? After doing everything here, they now brought even what more? They now brought buyers into the equation too, because now there are people who are doing what? Who are betting against these sellers too as well. So they've invited buyers into the market. And then what did they do? They helped facilitate this move. So they took out all the liquidity, brought buyers into the market, using the buyers now to actually sweep this liquidity. So buyers came here. You can see the break and retest of this level here. This is the level here. Let me color it. And then broke, retested, and then brought even more buyers into the market, and finally taking out any other sellers that would have had maybe higher stop losses. And then prices did what? Eventually started to sell to the downside. And now we see prices doing what? Moving to the upside. But something is happening here. We're finally shifting. Okay. Now, this is structure. Like I said, we'll come back to structure on the next episode of this webinars. Okay. We'll look at structure in depthly and how smart money takes advantage of structure to use them. But now, there's something also worth noticing in this point here. We see that buyers were in this market here, and we are noticing a pattern here. This looks like a what? A double bottom pattern. And we're told that in double bottom patterns, what will happen? We should buy at double bottom patterns. Now, if you're asked to buy at double bottom patterns, your mind, okay, creates this I'm looking for the word. It's like an anomaly, okay, that makes you think that you know this thing so much. It builds a certain level of overconfidence in you that when you say double bottom, you should buy. So now I want you to picture how many millions of people do you think have bought right now because of this double bottom? How much do you think possibly could be resting under these levels? Just take a wild guess. Today, I'm not here to teach you technical analysis. I'm here to help you understand what moves this market and how this market moves and how they've tricked us retail traders a lot of times. So what's happening here now? Everybody's buying. Oh, this buy is solid. This is the neckline, price is going to come here, price is going to continue to buy, and all of this and all of these things. Yes, prices could continue to buy. As a matter of fact, prices could buy. But when they are eventually going to come for this liquidity, they would come in hard. You know why? Because they've trapped a lot of buyers. They've created an illusion that the more you see, the less you know. So all you're seeing now is a double bottom for more buys. But you're confusing and not also identifying that this was still a valid resistance. Not just any type of resistance, but it was a weekly resistance as a matter of fact. And is why I always tell people, consult your higher time frames. When you look at the higher time frame, you would notice that we have this huge candlestick here. And this candlestick is what? Is a shooting star candlestick. Even if you're a beginner, you know what a shooting star candlestick is. You now see that this shooting star candlestick is what? Now, remember what I told you about liquidity? Huge candles with wicks that shows elimination of buyers. So the sellers did what? Come into the market aggressively. So when you come back to your weekly time frame, you would then understand that this resistance level could still very much be valid. So what does that then leave us with? That when we come back to this 4-hourly time frame, as a matter of fact, this could just be another engineered liquidity to fulfill a move to the downside before prices even continue to the upside. Or we even see prices finally start to sell off at this point. So you see, so in order for them to actually move this market, so if this sells is to happen right now, there was a need for them to do what? Eliminate every other person, every other possible, higher time frames trader stop losses that was here. And you know how swing traders are, big positions, good stop losses, 100 pips, 200 pips. They've eliminated everybody. So what do they now have? They've completed this transaction and now they can finally what? Exit the transaction and make their profit. So now they have bought off every sell stop orders here, sell stop or buy stop orders, stop loss orders here. They've bought up this position and now they are going to sell it back off. And when they eventually do, there would be no disruption for them in the market. As a matter of fact, they've engineered more liquidity for quick take profits at this level here because everybody is buying here. So when they eventually come back into the market, they would hit the market, take these stop losses, take them as TP1, TP2. Now, what kind of liquidity will be resting here? This will be the liquidity where at a previous, remember we said we had this, what type of liquidity here? Swing highs and swing low. So what is this going to be? This is going to be the liquidity resting at this swing low. So they have TP1 here, which is an internal liquidity that they've engineered. That's going to be TP1. And then they also have what? TP2 if they want to continue selling this market. Am I flowing? Are you understanding? Am I making sense? I want to know you're following, guys. If you're following, please leave something in the chat section. Then be sure you're following. I want to know that you're understanding this. I want you to be seeing the illusion that, occurs in this market, that sometimes when you come to your chart, you're just looking at price action only. But this is what really fuels the market. This is what creates the market. This is how the market is manipulated every time that we don't take note of. So now, what's the next we're supposed to look at? Now we're supposed to view what? We're now supposed to view accumulation points. So we've done structure, we've identified accumulation points, we've identified previous swing highs and swing lows. Now, previous session highs and lows for closing range. Now, these session highs and lows are more for intraday traders. Okay, intraday and interday traders. So this is what a session high and a session low would look like. Permit me to take off all of these drawings right now. Okay, so this is what a session high or session low will look like. So there's an indicator I like to use on the TradingView app. It's called the Lux Algo sessions. Okay, so usually for sessions you want to scale down to like the 1 hourly time frame. Okay, and then you can view all the sessions. It's a bit tight, but I just want you to pick the color. So the yellow or orange is the New York session. The red is the Tokyo session. Okay, let's go to the 30 minutes so you see it well. Blue is London. Okay, red is Tokyo. These smaller ones are usually the Sydney session. So now this was on so this is Wednesday. Okay, this is Thursday. Let's scale back down a bit. Okay, so this is Friday. This is Friday where the market closed on Friday. Okay, market closed here on Friday. Okay, so we have the market close at 8:30 on Friday. Okay, and this was the close of market again on Monday. Market closed on Monday at this point at 10 p.m. just right before Sydney session happened. Now, this is This is the opening range from Friday to Sunday. You can see that gap to the downside before prices moved up. Okay. So what simply happened now is people who had entered sales to continue selling, market did what? Had used their liquidity to actually fuel prices to the upside. Now, this was Tokyo session, London session, and New York session. The whole market this Monday on GBP JPY was ranging. So as a matter of fact, this automatically became where? This became the session highs for 3 sessions on Monday. So this became a session high. Now, what does that mean? Possible liquidity resting here. Why? Because we have series of multiple sell entries resting above these highs. Can you see it? Now, Sydney session came in and Tokyo session came in and even did what? Engineered more sellers back into the market again. Now, even though prices wanted to sell from this point, it wouldn't have sold from this point. You know why? There's still so much liquidity resting here. So instead, what did prices do? Prices then used the previous, the session, previous range from Sunday as a demand level for where their initial buy order blocks were from, trapped a whole sellers at this very point in time throughout Monday till Tuesday, just before London session. And what happened? We then finally see London session tap into this order block and use London session and use what? This liquidity from Monday and Tokyo session to do what? Rally prices to the upside to sweep the liquidity before prices even sold back again. If you're confused, let me know. But this is what we mean by session highs and session lows. Now, notice this session high and session lows here, when you zoom out again, you see that it actually tallies with possible area where people might have had their stop losses the previous week before the close on Friday. So this was still Friday. So people that took sells here also have their stop losses here. Look, what did this buy do? This buy went and took out every possible liquidity that was resting here. So a lot of people who took their trades on Friday would have broken even, meaning if they took their trade here, they all have their break even at this point. What the prices do, sweep all of them, take them out, and then continue to move prices to the direction where I wanted to go. So this is how you use intraday liquidity zones. So these are using sessions and intraday liquidity zones. You want to map out these highs and these lows for intraday. Are we together? So this is how, the market uses this liquidity. So it is your ability to actually spot these liquidities and wait a little bit and actually look at the market and say, what exactly do I think is going to happen here? Do I think that this market is going to flow? So what I want you to do after today's webinar is, I'm not asking you to question your trades every time. Okay. I'm not asking you to go and be wasting time instead of executing your wasted time. But I'm saying, don't just open your phone and want to take a trade. It is important. It is imperative of you as a trader to sit back and analyze the market ahead, so that when you're analyzing the market ahead, you can try to, look at the market and be like, okay, is there something I'm missing out? And a lot of times what we are missing out on the chart is identifying if we are the liquidity or not. And like my friend will always say, if you can't spot the liquidity, then you are the liquidity. Imagine people who are selling at this point, or people who came here to sell on this particular day and was expecting prices to continue going to the downside. What did they happen to become? Liquidity. So if you can't spot the liquidity, you become the liquidity. That's exactly what it is. I took a trade here, this sells last week, and prices came to this very point in time and slowed down. And I started to ask myself, why is prices slowing down here? Why is prices failing to continue? And then I told myself, I'm the liquidity. And what do I mean by I was the liquidity? This wasn't the exact place where these sales were supposed to happen from. This was just an engineering of liquidity again into the market. In order for this sell to start from, it needed to fully engulf into the order block that was resting around this Sydney opening range for Friday. So this was just what an inducement before the tap of the supply or order block in order for the sales to continue. I quickly exited this trade. So it's about discerning and looking at the market and knowing something fishy is happening here. What is happening here? And then you identify it, and then you just quietly walk out of the market so that the market doesn't beat you. So it's once beaten, twice shy. If you forget to be shy, you get beaten again and you learn again. And it's okay, it's completely fine. That is how you actually learn to understand and spot this liquidity on the chart. Now, if you want us at Valetax actually go further and have like a full-blown webinar on liquidity and looking at liquidity on this chart, and we do like a full-blown chat webinar where we're talking about liquidity and how to identify this liquidity, I want you to leave it in the chat section so that I know that I have a consensus that wants me to actually sit down and break down liquidity on the chart and show you how to play around it and how it's very important. Okay, so this is another example of session highs here. Again, can you see these highs between the New York highs and the Tokyo highs, and how London did what? Completely raided the liquidity around this level, and then prices sold to the downside. So this is a typical example of what session highs again, and it's usually what intraday. Okay, so this was London the previous day. You see this, so this London previous day did not fulfill the transaction. There was not enough money for them to carry out this transaction. So what did they do? They induced people here and left liquidity here and left liquidity here. So what did they then do? Came here on Monday again, eliminated everybody, and then completed their transaction, because at this point in time, probably they needed 300 billion here, and what was in the market was like 200 billion or 150 billion. They used this move to engineer both buyers and sellers, and left everybody hanging within this range before the end of the day. And eventually what happened, when they came in London, they slashed everybody to the downside. Pure market maker move. Okay, so this is liquidity. Now, the next liquidity that we need to look at is the liquidity on structure. Okay, so when we talk about liquidity on structure, we're talking about higher highs, higher lows. Okay, so I'm just going to kind of sketch it out here. So we're in a buy position like this. Okay, you've heard of break of structures, okay, and return to order block. So when you hear a break of structure is basically a sweep of what structural liquidity. So there's usually those greedy people that are trying to sell this short market. Okay, they're trying to go short on this market here for what? For the sales. And they sometimes would forget. They would forget that they're on the smaller time frame and still leave their stop losses here. What would prices do? Tap into an order block. And an order block has what? A huge amount of orders from institutions, plenty money, and it would just spike the candle and sweep this liquidity. So every break of structure is what? Is a break on structural liquidity. So this is also a swing high and a swing low. So a swing low here means that there's also liquidity resting below these levels. But this liquidity would only be taken out when a shift happens. And once this shift happens, then it's going to be a take out on every possible previous liquidity of swing traders that were in the market. If you want us to have another class on this liquidity so that you can understand it more and how I fully view this liquidity and how it applies to your charting and trading, I would be doing that. Okay, I'll create another webinar episode for us to understand that. Now, this is another style of how liquidity is taken out. So we have day trader liquidities and we have swing liquidities. Swing liquidities are the liquidities that exist on your higher time frames, and I would explain to you how they manipulate even the higher time frames too as well in the next episode of understanding smart money and market liquidity. So this is what I want us to understand and enjoy today. For risk management, it basically means that once you spot the liquidity, okay, once you spot the liquidity, bet against your fellow retail traders. If I know that this is a buy liquidity here, okay, this is a buy trade, so this is a buy side liquidity here in line with the trade structural. I know that if people are selling here and I know where the order block is or where my 61.8 Fibonacci is, and I see these people here, I would bet against them. So immediately what I would be doing is I would not be looking to want to sell here as a possible double bottom. That would be stupid. Instead, I'll be betting against them to actually go and sweep these levels out. Okay. And then I'll be placing my stop loss. I'll be placing my stop loss and be, trailing it or put it below, not this low, but the other swing low, not this one. So be smart. This can also be a possible liquidity that prices can come and sweep it as an internal liquidity, come into this support level back before going back up. So you have to be careful. A higher low that has not created a new higher high is not a valid point. We'll talk about this in structure in the next episode. Okay. So you have to be careful too as well, but always bet against the liquidity. That's how you manage your risk. When you're in a bullish trend, bet against the liquidity. Okay. So that is how we play this game here. Okay. So here are a few key takeaways that I need you to understand. Liquidity is simply a battleground for retail traders and institutional traders. This is what differentiates us. Retail traders are chasing profits. Okay. Institutions trade volume and liquidity. Smart money wins by understanding and exploiting. Retail traders win by trying to take advantage of every small move they can make. And why smart money always wins is because they have a footprint. They have internal knowledge of the market, of where volume and liquidity exist, and they exploit it. As a trader, your job is not to fight them, but to ride their wave. Is to understand how they are moving the market and flow in their pattern. Okay. And here is my call to action for you today. Understand liquidity so you stop being a prey in the market. So go online, do your research on how to understand liquidity. Journal your trades because you're going to be, while you're trying to understand liquidity, trust me, you would be the liquidity a lot of times. So journal those moments. Journaling those moments help you understand what happened and how you became the liquidity and where exactly the liquidity was and you missed it and how were your emotions at those points in time. Then have a daily checklist for your entries. So when you're able to analyze the trade, say Sunday night, have a possible plot of every possible place liquidity could be and have a total view and understanding of what the market is on a higher time frame and on a lower time frame. So whenever you spot a liquidity, there usually is a possible order block or a supply or demand level resting and waiting for prices to tap into it. So the reason why those liquidity is there is the liquidity is there to engineer the move, okay, to engineer the move towards the order block so that the transaction can be fulfilled. Make sense? The transaction needs to be fulfilled. So there's an order that has been left for that transaction. They gather the liquidity, run on the liquidities, activate the orders, complete the transaction. Free flow of money. That's exactly what happens. Okay. And now we've come to one of my best parts, the question and answer section. I don't want to believe that people don't have questions in such topics. So feel free to ask me your questions and I'll give you your answers that you need. Okay. So I'm going to go through the chat section now. So someone said, then what illusion? Then with that illusion, doesn't it mean you can only be a day trader or be holding for a really long as time to execute a trade? The truth about it is, it's not that it becomes impossible, okay? It doesn't become impossible for you to trade. The reason why you need to understand the liquidity is so that you understand that if you're a day trader, you can't stay in the market for too long. And you can easily spot where you're just being manipulated. See, day trading is one of the hardest types of trading. And why it is one of the hardest types of trading is it takes a whole lot of precision and sight, activeness to perceive and to react. You need to be very reactive being a day trader. So why understanding liquidity helps you is you can easily see where you're being manipulated as a day trader. Because if you can't spot where you're being manipulated as a day trader, you're just going to constantly lose money. Because every time you take a trade, prices goes against you and you're wondering what's happening. Your direction is not wrong. But in order for them to move to that direction, they need liquidity to move to that direction. See, where you see small candles start happening, just know that there are no institutions in the market and they are just baiting everybody because retail traders don't have the kind of money or the kind of transaction volume to move the market. You get? So that is why you have to pay attention and be very careful as a day trader. So know these things, and then it gives you more confidence to actually apply the kind of grit you want on your trade. Yes, that's what they do. One execution, big profit. So they use one execution to actually spread across, okay, spread across these trades and take both buy sides and sell sides and make as much money as they can and then let the market flow. It is now the people who see and identify these liquid zones and what the market is doing that are able to catch those big moves. So if you're not identifying where these liquidities are happening from, a lot of times you're just lucky enough to catch that 200 pips move, 300 pips move. But the people who catch these moves easily every time are people who play alongside with smart money and know that smart money is about to do something here. When they key in, that huge move happens. And that was exactly how I was able to catch that 300, 400 pips that I was able to catch on the XAUSD last week, trading XAUSD, because I was able to see the plot that was happening. Okay, I see people saying I should do another session on liquidity. Okay, I'll do another session on liquidity. Well, the truth about why people are snipers or not snipers is majorly not about that. See, a lot of people who say, oh, sniper entry is not so easy to be a sniper entry. But what makes it easier for them is when they identify this liquidity and they identify a possible order block, they can use those order block to perceive that, okay, prices should react rapidly from this level. So that's why, some people do sniper entries and using limits to catch sniper entries. They just identify liquidity. And when they identify that liquidity, they look for an order block and bet on that order block. So they are betting against the liquidity of the market or other retail traders. Is it safe to make trades once price tap on the fair value gap, or I wait until it taps on the OB? Honestly, what matters to me is not the fair value gap or the order block. What matters to me is which of them is nearest to the liquidity and which of them aligns and still keeps prices within the range of structure. So if your fair value is closest to your liquidity, there's a likelihood that that is the one that is going to be used. But if the other block is closest to the liquidity, I would go for the other block. The fair value gap can just be there, and prices will eventually come back to fill it or use it as this thing as a mitigation. The order block, for instance, if you're noticing an order block, yeah, the mistake a lot of people make is what makes an order block valued is the presence of liquidity. I'm going to do a whole this thing of how I view order blocks. Okay, what makes an order block valid is the presence of a liquidity. If you notice an order block without enough liquidity, you need to be expecting that an inducement should happen to create the liquidity before the order block. But if you have an order block and a fair value, okay, that order block might just be what I refer to as a mitigation block. So mitigation doesn't necessarily move that prices would move and continue. Prices could just react and then use that order block reaction for where it is now going to induce liquidity. So because people identify that order block but failed to understand the rudiments for making that place an order block, they all try to enter that order block. Meanwhile, there was never a liquidity to validate that order block. So that order blocks now become an accumulation point for where a lot of people would want to place trades. Now, this is how smart money, this is how smart money traps and manipulates other people trying to trade smart money without fully understanding the concept of smart money. So when they go and place more trades on that other block there, it now becomes an accumulation point. So prices will eventually sweep that accumulation point and then tap the fair value gap and use that fair value gap as the zone where they will now eventually fulfill those transactions from. I hope that helped you, Desmond. What time frame is best to look at for entry? Usually I use the 15 minutes for my entry because I'm a higher time frame trader. Okay, so that is um so I am guessing there are no more. I was able to answer three people's question with Desmond's question. Okay, so I would write all of these things down and keep them so that we can create a series. Okay, so we're going to have the part 2 of market liquidity, and then we're going to talk about structure, and we're going to talk about in that structure we're going to talk about premium and discount and how to use Fibonacci. I would keep this in mind to make sure that the next two sessions are all about this. Don't forget to invite your friends, share with your community of friends and traders that you know to always attend these webinars. You see how impactful this webinar has been. It has exposed you and it has also opened your eyes to a lot of things. Don't forget to invite your friends. And also, if this is your first time attending the Valetax webinar, don't forget to create an account and trade with Valetax. We have the best spreads on your ECN account. Well, ECN accounts, we mean spreads from as low as zero with low commission fees on our ECN accounts. And all you have to do is deposit at least just $50 to get started on your ECN account, unlike other brokers that you have to use $500, $1,000 for you to be able to use an ECN account. We're giving you instant market executions with zero spreads just for your first deposit of $50. And after then, you can deposit whatever amount you want as low as $1 on your ECN account. Okay. So get into this week, deposit on your account, and get trading with Valetax. And don't forget to watch the market outlook on our YouTube channel and our Facebook channel, where we share our weekly outlook on the next move with Valetax every Monday morning. So you have a view of what I anticipate for the market ahead of the week. So far, so good since the inception of the next move with Valetax. Every outlook that we've sent is not a guarantee for success, but had played out with our trade ideas successfully. So always pay attention so you have an idea on how to go about your trading week for the market. And I'll see you guys on another episode of our webinar series with Valetax. Thank you guys for joining. Thank you for staying till the end. And thank you for enjoying the session so far. I'll see you guys same time, not same place and not same date, but I'll see you guys in October again. Cheers, guys. And I'd love to see you all.